Hi, everybody. We have learned the concepts of Ind AS 40, that is investment property. What we would now like to do is spend some time applying those concepts with the help of several questions and case studies to test our knowledge on the subject. We are provided with this information which says that H Limited acquired an investment property, that's a building, for 4 lakh rupees on 1st of January 21. That has a residual value of 20,000 rupees. The useful life estimate of the building is 20 years. H Limited follows straight line depreciation method for the building. The question's requirement is what is the carrying amount of the building on 31st of December 21? Now, importantly, you would like to remember here is that for accounting purposes or for measurement purposes, and investment properties accounting is done as per Ind AS 16 property, plant and equipment under the cost model, right? Essentially, Ind AS 40 only permits the cost model accounting, and the entire accounting with respect to the carrying value calculation, with respect to the charge of depreciation, etc., is all driven by Ind AS 16, that is property, plant and equipment. And that is where this question becomes a fairly straightforward question to us. It says that I'm provided the cost of the building, I'm provided with the residual value of the building, I'm provided with the expected useful life of the building, and considering the year, this is the day one, the date of acquisition, and this is of course at the end of year one, after 1 year. We need to calculate the value of the building. How do we calculate that? Put simply, we charge depreciation for the year. And how do we calculate depreciation? We need to calculate it as per this approach. We first of all calculate the depreciable component. That's my first step. Okay. Now, how do I calculate my depreciable component? We say cost minus residual value or residual amount. We are provided with that figure of 4 lakh rupees and residual value is 20,000. Now this gives me the value of 3,80,000 rupees. The next step is, of course, my annual depreciation. How do I calculate that? It is again depreciable component divided by the useful life, which means that I'm calculating it as 3,80,000 divided by 20, and that gives me 19,000. That's my year one depreciation. What is the requirement of the question? Let's go back. It says, what is the carrying amount of the building on 31st of December 21? Now, simply put, I would say the carrying value or the carrying amount will be cost minus depreciation, which is 4 lakh minus 19,000. That gives us, of course, 3,81,000 rupees, right? That's a straightforward direct question to address. All right. Let's have a look at the solution formally. We are provided with the cost of the assets 4 lakh rupees, depreciable amount is 3,80,000 rupees, depreciation for the year is 19,000 rupees, and eventually the carrying amount is calculated at 3,81,000. All right. We are provided with the information which says that on 31st of March 2021, Partnership Limited has an investment property, that is a building, with a carrying value of 1,50,000 rupees, which is leased out for earning rentals. On this date, the company has terminated the lease and occupied the building for own use. Now, what you need to remember here is that the use has changed, has converted from the investment property to self occupancy, which means that we are talking about Ind AS 16, that is property, plant, and equipment. On the same date, by the way, the recoverable amount of the building is given at 1 lakh rupees based on management's estimates, and its remaining useful life is estimated to be 20 years and residual value is nil. The question's requirement is how should Partnership Limited account for the above investment property as on 31st of March 21. Now, importantly, you would like to remember here is that the transfer of the use has changed from an investment property. It has moved to another category, which is property, plant, and equipment, right? From the accounting perspective, you also want to remember that the measurement criteria as applicable to property, plant, and equipment under the cost model, right? They remain the same for the investment property. So effectively, from the accounting perspective, from a measurement perspective, nothing changes, which means that if I'm showing the building at 1,50,000 rupees as investment property, I will continue to show it at 1,50,000 rupees, even as a property, plant, and equipment, right? The transfer of use does not change this value at all. Okay, so that's the first thing that we want to talk about. And this being the carrying value of this property, plant, and equipment, I would like to compare that with the recoverable amount. Okay, which means that I would compare this with 1 lakh rupees. And by the way, in this case, of course, the carrying value is more than recoverable amount. And the moment we say the carrying amount or the carrying value is greater than the recoverable amount, it is resulting into an impairment loss, right? So we need to account for that loss, and accordingly, we shall be booking the or doing the accounting on that basis. All right. So how do we do that? We are saying that now the carrying value of investment property is 1,50,000, right? Now transfer to property, plant, and equipment is done at the same amount. All right. Now, as on this date, the carrying value of the property, plant, and equipment will be 1,50,000 versus that the recoverable amount is given as 1 lakh, which means that we need to recognize a loss of 50,000, right? Which means that after this impairment loss, post impairment loss, the carrying value or the carrying amount will be 1 lakh. And we are also provided, by the way, the expected useful life of this building is 20 years, which means that my annual depreciation is going to be my annual depreciation is going to be 5,000, right? So if I go back on the the requirement of the question, this is the way we do the accounting. The first step is to move it from the investment property category to property, plant, and equipment. The second step is we recognize, of course, the impairment loss. We also need to measure going forward, right? The going forward depreciation for this building is going to be 5,000 rupees every year. All right. Let's have a look at the formal solution. As at 31st of March 21, as per the Ind AS 40, it must transfer, the company must transfer or reclassify the building from an investment property to a property, plant, and equipment since there is a change in the use. All right. The second part is the building should be recognized or reclassified as property, plant, and equipment at the same carrying value. Now, since the recoverable amount of this building is less than the carrying value, which means that we need to recognize a loss and charge it to the P&L, and that the transfer has to be disclosed, by the way, in the financial statements. Now and onward, we shall be charging depreciation, which we calculated at 5,000 in our financial statements. All right. Thank you very much.